Welcome to Behavior and Risk, where we explore the intersection of decisions, the brain, uncertainty, and the business world. I'm John Burkhart.
And I'm Rich Loria.
We're glad you took a chance on us today. Usually on this podcast, Rich and I will look at a case or an example or an organization that has undergone some kind of extreme case of risk management, either a great failure or a great success, and examine what happened, why it played out the way it did, and what lessons can be learned from. Today, we're going to do something a little bit different. We're going to focus on an episode that is presently unfolding, something that really has not played out, and nobody to this point knows how ultimately this is going to resolve. And this is going to allow us to do something which we've not really done a whole lot in the past, which is make predictions. We're going to stand up and say what we think is going to happen. This is the put up or shut up time for Rich and I. And I think we're both excited and very nervous about this. And what we want to look at today is the emerging and ongoing case of Blue Owl Capital. Blue Owl Capital is an entity that takes part in the large and growing private credit industry. At last evaluation that I saw, the sector has something on the order of $2 trillion in assets available or under management. And there are some very interesting things that are unfolding around Blue Owl Capital and many of the investors and adjacent organizations that are involved in this private credit market. Now, Rich, I have a lot of thoughts about this because private credit itself is a domain that is prone to all manner of cognitive biases and heuristic thinking, both on the investor side and on the people who are taking credit. And this can lead to all manner of, let's say, atypical by classical economic evaluation outcomes and happenings. And I don't want to get too crazy or go off of too many wild hairs here. So what do you see as the major relevant happenings and facts of this particular case?
Thank you, John, for teeing that up. Yes, the private credit industry has grown to be roughly a $2 trillion behemoth. And it is something that has grown pretty rapidly over the last few years. But I want to just tee this up a little bit for our listeners, in that the concept of a private placement or a debt instrument that has been issued privately is not really a new concept. Banks have been providing loans privately to customers for decades, if not over 100 years. And certainly in my prior lifetime, a major asset class of the insurance industry are privately placed bonds. And many insurance companies even have their own team, their own lending team, mortgage team, that will seek out and provide credit to those out there that are looking for capital to support new projects and looking to borrow funds. So the idea of this private credit is not completely new, but I think what is different in terms of this iteration is that now it's become a major source of funding for all sorts of businesses. And it's grown into a very large asset class in and of itself, rivaling certainly what's going on in the public sector. And that has a lot of implications, because the question becomes, why would a borrower not just go to the public markets and issue debt and go through all of that? And I think there's a number of reasons for it, but certainly not the least of which is that there's a lot of things around that. When something is traded in the public market, it requires public appetite, which may or may not be there depending on market conditions. By going and obtaining financing on a private basis, a borrower can more shape what it wants to what its needs are and is not subject to the market vagaries. Also, with market vehicles, particularly debt vehicles, they have to meet typically certain conditions in terms of the way coupons are paid, in terms of how tranches are set, and so forth. So the terms and conditions tend to be more standardized in a publicly traded bond issuance, whereas with a privately placed one, it can be more customized to the underlying financing needs of the borrower. So in that light, with regards to what that marketplace has shaped into. And we're going to get around now to the whole Blue Owl. The title of this is the Blue Owl Capital saga, which is, as John mentioned, an ongoing situation that we don't know exactly how it's going to resolve. Private credit has evolved into something that is more accessible to all types of industries and allows for other investor capital to come in. So just as private equity earlier in this century and even extending back into the end of last century became a growing market, private credit is a way for accredited investors, those who have more sophistication, to get exposure to the bond markets in sectors that they might not be able to have access to just using public securities. That's great from a diversification standpoint, which is ironic given what I'm going to be saying later on about this, because part of the issues going on are diversification related. But it's great from the fact that investors can now get more diversification, more industries have access to well-heeled investors, and can therefore get terms that are more amenable. And there's more competition essentially for the loans that they're seeking to make. Now, how this relates to Blue Owl is specifically with regards to the IT services industry, an industry that has to some degree been, I don't want to say shunned, but they've had limited access to capital, particularly from banks, because of banks' underwriting standards and some concerns about the creditworthiness of the industry, the growth potential of the industry, and so forth. So the fact that now private credit has embraced this, private credit has expanded opportunities for IT services, particularly software services companies, to have access to the debt markets. And that's where Blue Owl Capital comes into play. So Blue Owl Capital is a huge player in this space, and they have a number of vehicles, both publicly traded vehicles and truly privately placed ones. And with regards to what happened with Blue Owl Capital, they had a vehicle called OBDC II. And OBDC II was a sibling to OBDC. And OBDC II is the private credit version of the OBDC one, which actually has a net asset value, and the underlying value of its loan portfolio is available for anyone to see. So what triggered the issues with Blue Owl Capital was the need for liquidity within OBDC II, and the management believing that, gee, if we take OBDC II and merge it with OBDC, all of our investors from both of those vehicles will have access to liquidity. So that's what triggered all of this, because what wound up happening is that upon the proposal of the merger, investors got cold feet about it. They were concerned because the net asset values of OBDC were significantly discounted relative to OBDC II, and there were concerns about losses, which management wound up acknowledging there probably would be.
My understanding is it wasn't even specifically concerns, but it was a locking in of a 20% loss on OBDC holders.
That's correct, John. So clearly there was an understandable sense of loss aversion and not wanting to recognize loss. And that led management to have to pivot and consider an alternative to the liquidity needs of the OBDC II vehicle.
I find this really interesting for a variety of reasons, because I see so many different things clustering around in terms of behavioral phenomena that precipitated this really cascade of problematic outcomes. I think it's important to point out that a big reason why there was this attempt to lock in some liquidity for the OBDC II fund is that basically Blue Owl Capital had made a bad bet. A huge percentage, I believe it's 70% of its holdings, were on technology-focused loans, as you discussed, particularly with SAS, software as a service organizations. And over the time course through which this has played out, which is to say late 2025 through present day, a lot of these software as a service companies are getting absolutely destroyed by AI availability. Organizations that would have had a great deal of revenue from small businesses and medium-sized businesses are losing it because these businesses find it much more financially efficient to go ahead and just outsource basic software functionality to ChatGPT or Claude or OpenClaw, which is something we'll talk about in a subsequent episode. OpenClaw, spoiler alert, has some interesting dynamics around it. Anyway, coming back to Blue Owl, basically they bet bad. They decided that here's a sector that we're going to underwrite their debt. They went with some non-standard company valuation approaches. They basically underwrote the loans against recurring revenue rather than overall earnings. This is typical for any sort of software service-based organization, but not how organizations writ large are typically valued. So the models don't really work well for them, and AI turned the table over. This is, I think, a really classic example of what we've talked about a lot as the variable baseline problem. Blue Owl Capital had these models in place. They had figured out what sort of volatility they could tolerate, what sort of assets they could allocate towards these different types of loans and what their risk values were. And these models worked great until the underlying landscape shifted. This is what I would term a black swan event. I know Taleb has some different definitions of it, but in terms of the baseline shifting, I would consider this a black swan. And this, of course, then cascaded into a need for liquidity for the OBDC II fund. And where I find this interesting, another compounding of perhaps behavioral error is asking their shareholders to face a locked in 20% loss in value. You and I know, because we've been doing this for a few years, that yes, we say that people are risk averse. They don't like seeing uncertainty, but this is only true when they're facing gains. When people are facing losses, they hate any certainty of losses. And so with a certain 20% on the table, people will happily roll the dice, even though the baseline has shifted, even though the market is volatile and correcting and nobody knows where the correction is going to land. Shareholders would much rather hold and basically gamble against, you know what, hopefully things are going to be better down the road, rather than say, we're just going to soak a 20% loss in value. So this is something that if you had asked me, should they have done this? I would have said at the time, absolutely not. This is the absolute worst thing you could do. You're absolutely not going to get shareholder buy-in for this approach. But it's understandable why they wanted to do so.
Yeah, John, they completely ignored not only prospect theory, but they also ignored the realities that they had been messaging certain optimism in the underlying fund performance. And then to turn around and say, okay, we're going to do this merger. And when we do this, you're going to lose 20% of your value on day one, even though we've been telling you you had a higher value. That just doesn't hang together. And in fact, it really shreds credibility. And it does not also acknowledge the fact that people tend to anchor into a prior number that you gave them. So if I told you that you had assets worth 100, and then I turned around a day later and said, oh no, those assets now are really worth 80 because we did X, Y, and Z, you'd say, what the heck happened? And I believe that's also a big part of the issue here. And I think that gets back to something you referenced earlier, John, which is how a lot of these non-traded, right? So OBDC itself is traded on public markets. There's a net asset value and so forth, even though it's backed by privately placed loans versus OBDC II, which is completely in-house and is subject to its own internal valuations and standards, which, as you alluded to, are using non-traditional techniques based on underlying revenues and not necessarily profits, which to some degree is understandable given that a lot of these loans were made to firms that had never generated a penny of profit.
Yeah, there was some questionable judgment, I think, and I think a lot of it is understandable in retrospect, but the effect that it had on investor confidence really should have been foreseen. On February 5th, one of the co-CEOs at Blue Owl told investors on an earnings call that basically they had green flags across the board, that everything looked great and we're going to have great profits. And then 2 weeks after that, Blue Owl permanently closed redemption window for OBDC II. This is a huge set of mixed messages. This is basically telling people, hey, everything's great, no problems, no reason to be worried. Not even that. You should probably put even more money in because we have green flags across the board. And then locking up asset value with no redemption and permanently such. Basically saying, yeah, we're not going to let you take money out anymore. And we are not going to tell you when this is going to change. And I believe quarterly redemptions were basically replaced, and management had discretion to issue distributions whenever they chose to, with no announced schedule or even roadmap at that point. This is a recipe for panic. This is basically how you undermine every single bit of certainty and confidence that people have in an organization. I think it's not incidental that shares fell basically two-thirds from their January peak after that shift in policy, and that there are at present, at the time of this recording, 6 class action lawsuits that are currently underway against Blue Owl because of this locking up of investor funds.
What I found interesting was the way that they tried to frame and characterize some of this. And I think one of the things I want to point out here that I'm not sure you mentioned is that before they completely went to this discretionary distribution, that i.e., we'll pay you when we feel like it, they did sell 1.4 billion of loans at par, and they used the proceeds to pay out 30% of net asset value to those requesting distributions. So there was a one-time payment of capital back to investors, but then they shut the door. And I believe what they did here, and again, you're the neuroscientist, so I'm going to defer to you, but my interpretation of that was they wanted to bring certainty and clarity and control to what was going on in a situation that had become too volatile to continue operating under normal procedures.
I think that whether or not that is true depends on where you are seeing the certainty and control, because in that particular execution of strategy, they retained certainty and control internally among the asset managers at Blue Owl Capital. They undermined certainty and control completely on the part of the investors. Whether or not they intended to, what they in fact did was set their investors down the road to learned helplessness. That is to say, the certainty that you have no ability to influence the events around you. Interestingly, this is a clinical model of depression in the research field. Learned helplessness is something that our brains don't like, and if we have any opportunity to, we try to avoid. And I remember thinking when we first were being introduced to this case and we heard about this freezing of assets and the ceasing of quarterly distributions, I remember wondering, why the hell would they do that? This is just a way to guarantee that nobody will ever again put money in your fund, that you have basically closed the tap to any sort of future investment. And I think that's true, except that if they were facing such a significant loss of valuation and the fund collapsed and they went bankrupt, they are also facing the complete certainty that nobody else is going to invest in their assets in the future because there will be no assets to invest in. And so I think this is a case of the reflection effect on the part of the Blue Owl asset managers themselves. Yes, it looks awful externally. The optics on this are terrible. And nobody is ever going to invest in Blue Owl Capital again unless they land a home run. And it may well be that they have some exotic strategy on the books that they are trying to execute now, and they need a certain amount of investor capital tied up in order to execute it. And if they can pull it off, all will be forgiven. And in fact, they probably will be seen as, hey, here are these brilliant wunderkinds who spun straw into gold. But the only way they can pull that off is by risking being pariahs in the financial space for decades to come. So I think this is a case of them gambling, of saying, we're screwed no matter what, so we may as well swing for the fences.
Yeah, John, I think you're on it. I think they went through the dark scenarios of either going down the path, as you indicated, of continually trying to get the liquidity and continue to pay out redemptions as demanded, and probably with the fund completely spiraling and collapsing and investors hemorrhaging losses and a permanent damage to the brand. Can't do anything about it. You're done at that point. And I think, to your point, they saw that path was most likely going to lead to just complete disaster and not much in terms of any redemption value. Whereas they took the path of, okay, we're going to roll the dice, and maybe it's going to be even worse with what we do. And certainly we're going to take, in at least a short run, a massive black eye from accredited investors. You're right. No one would understandably trust them with their money again. And I think it's not just the capital that they're hoarding. I think they're also buying time. I think there's a significant time dimension. And it makes me think of past cases we've talked about, like the long-term capital management. I know when people involved in that were interviewed post-event, they said, gee, if we just had another, I don't know, X number of weeks or months, the markets would have come back and this would have all recovered. I think that's what they're doing, is they are laying low and they're looking to buy time. My only comeback to that goes back to the underlying cause. So if we go back to root cause, which is always a key thing in risk management, the underlying root cause is the incredible amount of concentration in an industry that is hemorrhaging because of the AI phenomena. And by the way, just for everybody out there, we're going to be doing other episodes related to AI, and I have a feeling that we'll be talking about disruption in other marketplaces and in other industries in those episodes. So just a little bit of a preview for all of you out there. So I think they wanted to buy time as well as hoard capital in order to work out of this. But I'm not sure what that path looks like going forward. And I'm not sure that they know what it looks like. I think they're hoping that at some point there is a reinvention of the SaaS industry. The folks in these industries are smart people. They're going to look at the landscape and try to figure out a way to pivot, perhaps even integrating AI into what they do. And that may be all part of the plan. They may have had conversations with some of the borrowers to that effect, that, hey, just buy us some time here. We're going to figure this out.
I think you attribute more goodwill and noble intention than I do, which is a fancy and polite way of saying I'm a cynic, and I think maybe you're not. Because while narratively I do believe that makes sense, I have to think that if that were the case, they would be screaming that from the rooftops. Because right now, Blue Owl is taking a beating in terms of public opinion. They look awful. And if they had even the vaguest shell of a plan, I think they would at least be saying, hey, we know this looks bad. We've got something that we're working on. And to date, I'm not aware of anything like that being put forward.
So I agree with what you're saying. And I believe animal instincts and survival instincts took over in this case, John. And I believe that's the primary reason they did what they did. So I agree with you on that basis. I believe they also rationalized it because, again, what they did was incredibly antisocial in the investment world. It is the equivalent of completely shunning and turning your back on those who have trusted you.
I'd be even more blunt. I would say it is theft by appropriation. They have basically declared functionally that these funds are now ours. We'll give them back when we feel like it.
Right, because in the contracts, you could take up to 5% of your net asset value on a quarterly basis. You could do that each quarter as an investor, and that has now been reneged on, right? That has been essentially altered in terms of the operations. And I don't know if there's anything in the contracts. I have to imagine the lawsuits are flying, John. I don't know, but I have to imagine that the lawyers over at Blue Owl are quite busy right now. I also believe that they took that into account and are positioning a defense. And it's interesting going back to the framing of their actions. They pointed to the 30% one-time payout as an accelerated redemption. And I believe that framing will continue in the courts and in especially the court of public opinion.
I think all of that makes sense. I just find it a really interesting illustration of how people reason and make decisions when they are faced with bad options all around. Because they could have just said, okay, we're screwed. We're going out of business. Let's fold up shop, pay out pennies on the dollar. And in 2 to 3 years, probably we can get a job somewhere else. You know, you can't buy that kind of publicity. But instead, they chose a path where there is a very strong possibility, in fact, I would say probability, that they're going to have the same sort of financial outcome at the end of all of this. Plus, now there's a possibility that people are going to jail. There hasn't been criminal action as of yet. But depending on how these lawsuits play out, and depending on what view the regulators take of the actions, they're facing very significant legal action, which would not have been on the table at all if they had just said, oops, our bad. Here's what we've got left. We'll find a job in a few years. Facing that potentially worse scenario down the road is seen as better. It's seen as a more appealing option. Delaying the pain, avoiding the hit as best you can, even if the eventual hit is going to land stronger. That is just something that, however irrational, you know how much I hate that term, however irrational or nonsensical that decision may be, that's the direction that people tend to make their choices.
Yeah, and it all comes back to what you taught me on day one when I first met you, which is we are about survival and reproduction. And in their minds, they are trying to keep this entity surviving as long as they can. And whether rightly or wrongly, and look, I agree with you. I think the chances of them pulling off a home run and a massive turnaround with this are between slim and none. However, between slim and none is better than absolute annihilation, which is what they were going to face if they just allowed these funds to be ripped open and have investors try to go in and take whatever shreds they can get. They would rather hold on to the money and battle them in court and kick the can down the road. And as I said earlier, I really believe they're trying to buy time until a viable strategy comes. So look, what I said earlier, you're right, John, maybe there isn't that kind of belief, or there is, I don't know what conversations they're having with the borrowers. Although again, I believe they're having conversations with the borrowers because these things are all connected together. I'm sure they're getting assurances in some way, shape, or form from borrowers because their companies don't want to go out of business. I mean, I haven't seen a whole lot about bankruptcies in the IT software services industry. I haven't seen that kind of thing. Maybe it's coming and maybe it's just more low key and doesn't get the kind of buzz in the media that bigger types of collapses do.
I really like your comment about doing anything they could to keep the organization surviving, because I think when we consider that, it explains a lot about what we see in some of the other responses within the sector as this case grew larger. We haven't really addressed it yet, but while Blue Owl is the epicenter of this, there has been industry-wide contagion throughout the private credit markets. Lots of private credit issuers are suffering right now, or at least taking significant losses. Two of the other players are Blackstone and BlackRock, and they responded quite differently than Blue Owl did. Blackstone basically increased redemption limits as share value started dropping, as value started dropping from 5% to 7%, and they injected $400 million into a feeder fund. BlackRock basically said 5% is our limit, but you can continue to draw 5% as this goes. Essentially, both Blackstone and BlackRock said, yep, things are not good right now. We understand. And if you want to move your money elsewhere, by all means, go for it. But this makes sense because neither Blackstone nor BlackRock are primarily private credit issuers. They are asset managers. They have holdings across every conceivable domain. And sure, they're going to take a significant loss on this, but a significant portion of the people who are moving their money out of their private credit funds are just going to lateral it into another asset that they hold. And so, from the point of view of them, this is not really a loss. And more importantly, they have the size and scale that they can survive this. Even if their entire private credit division goes under, as long as they're not excessively leveraged, and I will say, in fairness, I have no idea what their leverage positions are like around this, but assuming that they have learned their lesson from long-term capital management and they're not excessively leveraged, it won't be pretty, but they'll survive a complete bankruptcy of private credit. And so they don't need to make that ridiculous decision that Blue Owl Capital did.
Well, it's interesting, John, that you mentioned Blackstone and their decision to be accommodating. Not only were they accommodating, but management is literally putting their money where their mouth is. Out of that 400 million that they injected into a feeder fund, 150 million came from Blackstone's senior executives. So it's clear that unlike Blue Owl, which went completely rogue and antisocial and was willing to roll the dice on massive class action litigation against them, Blackstone did the complete opposite. They decided to be fully accommodative to the point of saying, yeah, we really respect our brand. We don't want to do anything to tarnish it. We know the power of it. And we're willing to even have our own executives likely lose money. It's a temporary type of thing. And in the long run, it's going to help our franchise value, which takes a lot of foresight as well as holding your nerve to be willing to do something like that. Because again, when I think about the time dimension and intertemporal choice, most people I know would not be willing to forego funds today with the anticipation of greater gains in the future from taking such action. That's not a very typical human reaction, especially when markets are collapsing and hemorrhaging and so forth. But to your point, John, both Blackstone as well as BlackRock do have powerful franchise values. They also have the benefit of a diversified portfolio of offerings. And I imagine that even though these are both big funds for both of them, they're not chump change. This is something they can survive and they can think with more of that foresight.
When looking at Blackstone's liquidity injection and the 150 million from the senior execs, what I'm reminded of, and I'm very much showing my age here, is Lee Iacocca. This is something that many of our listeners probably don't have a whole lot of familiarity with. And I'll admit, I was very young when this happened. But during a period of major insolvency for, I believe it was Chrysler Motor Corporation, Lee Iacocca was CEO and had asked that the unions take a very significant salary cut in order to keep the company solvent. And Lee Iacocca slashed his own salary to $1. For the following year, Lee Iacocca's salary as CEO of Chrysler Motor Corp would be $1. And the unions gritted their teeth and took the pay cut because otherwise the company wouldn't be there and nobody would have a job. This, of course, is not nearly so extreme an example of that, but it is something where senior leadership, the people who are making the big bucks, are saying, you know what? We are going to shoulder the lion's share of this. And this is, if anything, one would expect to see a greater loyalty, even if the assets continue to devalue because of a measure of reciprocity, because the investors and shareholders will see that the leadership of BlackRock, not the asset managers, but the people who we hear the stories of, these fat cats who are taking home seven-figure bonuses, ponied up 9 figures to try to keep us afloat. Whether or not it was purely for PR, and I'm sure there's a calculated measure of PR to this, people see that and feel a measure of indebtedness. I bet that's going to do a lot to get people to invest further in other, I'm saying BlackRock, I keep meaning to say Blackstone, in other Blackstone holdings, because it creates a sense of one, indebtedness, and two, security and stability, that they're going to do what they can to keep my money safe. I also think this might be, how do I want to phrase this? And I offer this is purely speculation. This is a poaching of Blue Owl customers because if you are an investor whose assets have been frozen by Blue Owl and you see that Blackstone is over here, and not only did they increase their withdrawal limits, but they have personally taken a stake in stabilizing the fund value, which brand are you buying?
Yeah, I agree. I mean, you have to feel much better about Blackstone. It also shows that Blackstone has ultimate confidence in what it's doing and that they believe that, yeah, we got ourselves into some hot water here. We took part in an industry. In fact, we're the biggest ones in this particular part of the financial services industry, in the asset management industry. But we're going to put ourselves behind it and we're going to weather it this way. And we're not going to put our clients' capital at any more risk than it has to be because we're the ones who sold the product and we're the ones who are in this with them. And that feeling of partnership, that feeling of accepting some level of accountability goes a long way, particularly in a trust business like asset management.
So we've talked a lot about Blackstone and the very accommodating, one could almost say aggressively accommodating approach that they took. What about BlackRock? And I have to make sure that I'm saying the correct agencies here because there's way too much similarity in the names here. But what about BlackRock, where they really did nothing? And somehow, because of the actions that Blue Owl took, doing nothing seems accommodating.
Well, everything is relative in the business. So if you compare BlackRock to Blackstone, then they appear to be not generous and not accommodative. If you compare them to Blue Owl, then they seem like Santa Claus and that they were accommodative. I would argue that BlackRock took a middle of the road approach. They took essentially what I think status quo bias would indicate you do, which is you follow your contract. Your contract says you are limited in terms of the amount of redemptions that you'll honor, and you stick by it. You are being a fair and balanced broker about everything. You're not keeping the money away from your investors, but you are reminding them that they signed this contract and they're limited in terms of what they're able to take out. And you remind them that with investing, you have to be able to work through market cycles. I think that's probably the messaging. It's difficult messaging. It's like asking your child to eat spinach, eat your vegetables. But it's a message that I think in the long run has some good things going for it too. And that although BlackRock's share price suffered when they made that decision to not be more accommodative, that in the long run, they're going to better manage the integrity of the fund and also not set unrealistic expectations. I think the one flip side of what Blackstone did is that there now is a precedent set that when things get bad, they're going to come to the rescue and help investors out, even though investors did sign the contract and made the decision to invest in a particular fund that Blackstone is operating on their behalf. So I think there is somewhat of a precedent setting and moral hazard that can be introduced because that 150 million, that 400 million of feeder fund, including the 150 million from the executives, operates as an insurance policy, and investments are not insurance policies. So when I compare what BlackRock, and by the way, not just BlackRock, but a lot of other private credit managers did, such as Morgan Stanley and so forth, what they did in some ways makes a lot of sense to me because you're just, yes, things are rocky. Everybody's concerned. Everybody's wants their money out now, but there's a contract. There's a reason these provisions are in place. And it's going to allow for a more orderly liquidation. There's not going to be this massive fire sale, which is going to create a herding effect, which will just accelerate a downward spiral of the value of these underlying assets.
You headed off the question I was going to ask you about the BlackRock versus Blackstone responses. And I agree. I think that there is a profound cognitive anchor that has been set by Blackstone being so accommodating, and accommodating is not really even the correct word, but caretaking their investors so thoroughly. They're setting themselves up potentially for future failure because now there is an expectation, there is a prediction that investors will make that if things go bad, they'll take care of us. And if they do, okay, great, nothing's wrong, but that gets to be an expensive proposition very rapidly. And if they don't, there is a major prediction error that occurs in the minds of investors. And the downside perception is that much more powerful. Now, the reason why I'm not quite prepared to come down and say that this is a foolish move on the part of Blackstone yet is because we talked about obliquely that there probably are many different imperatives driving this particular approach, this particular decision and position that they took. And if this is in part, which I think you and I both would agree it is, a marketing pitch, a way of advertising themselves to the market at large and saying, look how good we are. If they believe they have a very good position, the associated influx of investors and capital could be sufficient that it doesn't matter if there's prediction error down the road.
I agree with that, John. I certainly don't want to sound like this is something that's going to blow up in the face of Blackstone. It might. And look, any course of action when there's a crisis and there's a choice between a number of unappealing choices is going to have risks associated with it. I give them credit in terms of, well, I don't want to say it's a novel approach because you brought up the Lee Iacocca example, but it's certainly not one that I've seen practiced very often in the financial services industry. So the fact that they were willing to put themselves out on a limb and do this kind of caretaking on behalf of their clients is a relatively novel approach. And it could work out quite well. It all comes down to how frequently will such events occur. And the problem is, if we are headed into a situation where the economy goes into a massive tailspin and the capital markets go through some really bad stuff, the market is significantly down this year. At this time, March 31st, we're recording this 2026, just to put that in a time capsule. If things continue as they are and there's a lot of pain going on, then this sort of strategy is not sustainable. So that's the underlying risk, but it's one that could easily work out if things go back the other way.
So that brings me to the question that I've really been wanting to ask, which is where do you see private credit market as a whole going? I am inclined to think that the precipitous decline is probably going to stabilize in the near future, but I think we're in for a lot of volatility because I think the shape of the market is still being defined. And I think this particular instance is going to cause way more regulatory attention to be focused on it. And what ultimate shape that regulation takes is very much TBD.
Yeah, that's a tough one, John. I don't know if it's going to be so much a regulatory reaction. There probably will be some, but the problem is once you bring regulation in, then the asset class is no longer doing what it purports to do, which is providing a customized a shortcut with limited disclosures, limited information requirements, all this other type of advantages that you get from the market. And that will unfortunately close off avenues for borrowers. I think things that will happen will probably happen more quickly with regards to investors themselves, and in particular asset managers and their own underwriting requirements. So I believe what will tend to happen, and we see this with other credit crunches, is that underwriting standards tighten. So some of the valuation techniques are going to be revisited, maybe revised, and there's going to be less capital available to unworthy projects. And I don't think that's a bad thing because that's what the capital markets should be doing. They should correct when there are imbalances. And there should be adjustments accordingly to who is available for this kind of funding. I really think, given the current landscape, particularly politically in this country, and I don't want to go into that, I don't see a lot of increased regulation on the horizon. I think it's going to be more of a market correction in and of itself, in no small part because I think investors will be more reluctant to get back in the water.
I'll go ahead and make a concrete prediction, and I'm going to indulge some risk here that I could be completely wrong. But I do think this is going to happen. I think one of the direct consequences that we're going to see is a reevaluation of valuation models for companies that don't have a standard brick and mortar and B2C revenue model. The valuation approaches that these private credit issuers have used for the software as a service companies really were built for the early era .com, the Amazons. But people forget that for decades, Amazon was not profitable. In fact, it was net negative and survived entirely on investor influx. And those are the kinds of investment valuation tools that are being used for these software as a service companies. These are not analogous organizations. They only really are analogous in the sense of they don't have traditional revenue streams. But the structure and the operating models are fundamentally different. And any sort of pricing, whether it be for mergers and acquisitions, for issuance of credit, for issuance of stock, are going to need a very different and specific set of tools. And I think this software as a service, if the sector is going to continue, and that is also a very much TBD conclusion, depending on how AI continues to evolve and emerge. But if the software as a service sector is to continue, it's going to need better pricing and better valuation approaches. And I think these financial organizations are starting to realize that.
I don't think that's a bad prediction, John. We'll see how that plays out over time. I question if the whole software as a service industry, I have a feeling it's going to look very, very different in the next 5 years. I think things are moving so fast with AI, things are moving so quickly with technology in general, that I think there's going to be a lot of merger and acquisition activity in the industry, and that's going to lead to a whole recalibration of where capital goes.
I think that's reasonable. One of the things that we've seen in preparation for a number of other podcasts that are still to be recorded is that the AI is a huge disruptor, that many sectors are not going to look anything like they did 5 years ago, 10 years into the future. And I think software as a service is one of the most likely candidates for disruption. But I think it's going to be a very similar shape of disruption in that there will be a handful of survivors who become very successful that will prey upon the corpses of hundreds of software as a service companies that just didn't adequately adjust.
Yeah, I think that's where it's going. There are typically survivors, and those survivors figure out what the next successful iteration looks like and what changes need to be made to an existing business model in order to be successful in the coming years with the new technology that's available and the new forms of competition that are displacing what their traditional modes of revenue streams were.
I'll make another prediction, and I don't think this one is going out on a limb too far, but I could get this one wrong. And this is that I think Blue Owl Capital is largely done. And I think over the next year, it usually takes a while to wind down a fund or a fund management group this large, but I think over the next 12 to 18 months, we'll see a gradual cessation of operations. As we discussed, it is possible that they have some play yet to be revealed that is going to make them whole again. And honestly, I think that needs to be what would happen. They can't just stabilize, they need to be made whole and ideally come out ahead in order to restore any sort of future investor confidence. And while that's always technically possible, I see it as incredibly improbable. So I think Blue Owl is likely done. That's my own evaluation. I could be mistaken, but I would short them. Yeah.
Okay, so John, you're putting yourself out there, short Blue Owl. Yeah, that's an interesting one to react to. I hear all the arguments you've made are sound ones and certainly ones that I tend to agree with. However, I still go back to what I said earlier in this podcast about them buying time. I don't know if there's a master plan behind all of this. I do believe that this was all, at least initially, driven by instincts for survival. However, I can't believe that they don't have some sort of sketch of where they want to go. And it could just simply involve waiting for a white knight to emerge. Again, I don't know much about their operations, so I'm really not speaking from a place of knowledge here. But if they do have, let's just say hypothetically, some valuable businesses and funds that are worth investing in, then it may be that someone comes in and does some type of splitting of the assets into those that are toxic versus those that are not, and may decide to make some type of capital injection, do some form of merger or acquisition. What I will say is that Blue Owl is not going to look the way that it has in the last couple of years. If it exists at all, it's going to look very different. However, I'm probably not as dire in terms of do I think they're going to go bankrupt? I mean, it's a possibility. I think it's more likely that someone will come in and inject capital. Because even going back to how this whole crisis started, part of the issue that Blue Owl ran into, particularly with OBDC II, was that the funds stopped growing. And it actually had kind of a Ponzi scheme feel to it, in that they were able to meet redemptions because they were using new capital supply to provide those redemptions. And we've had these kinds of conversations before. We just did the GPB capital. So it kind of has that same feel to it. I think someone's going to come in and say, yeah, there's something here that can be salvaged.
I don't really disagree with any of the scenarios that you've laid out. I think all of them are plausible and possible. I'm going to show the listeners here a bit of how I do my back of the napkin risk management evaluations. And I realize there's a certain irony here that I'm talking to you about how I do heuristic risk management when much of what we talk about is why you should avoid using heuristics in risk management. But if you need to do a rapid guesstimate, one of the things I look at is how many things do you need to go right in order to stay alive? And I agree that everything you just laid out could conceivably happen, but every one of them has to happen in order for them to stay afloat. Their ability to take on standard investor capital is done. Short of them returning greater than 100% of original value, no meaningful critical mass of investors is going to invest with Blue Owl Capital again. Is there a white knight? Maybe, but that would mean they'd have to completely change their product and service set because issuing shares is done. That they're not doing that anymore. So it could happen, but there are too many links that could snap before any of that finalizes. And so that's why I'm maybe a bit more critical.
You're right, John. What I've laid out is a conjunctive process. And we've talked about that, in our book, that with conjunctive processes, and I've probably done it here, conjunctive processes often get overestimated in terms of the likelihood of success because of optimism and because there's a tendency to forget that you have to multiply probabilities together. You have to multiply a bunch of numbers that are all less than one together. And when you start multiplying fractions together, the product gets smaller and smaller and smaller. And sometimes people, and I, despite my math background, sometimes I fall prey to this. I forget how much that likelihood has to shrink. So I could easily be wrong with any of this.
This is a still emerging and potentially fast moving case, unlike basically every episode we've recorded at this point, where we can look back and say with pretty clear certainty, this is how things ultimately unfolded. These were all the players. These are the decisions that were made. And as a consequence, I don't think we have quite the same array of take-home lessons for this particular case that we try to have for many of our other episodes. Because quite frankly, we don't know what's going to happen. Rich and I have made our predictions. Naturally, I think I'm right, and that's what you should probably use to judge the future. But there is a possibility I'm mistaken. And I think that it is very likely that in another year or so, we're going to be doing a follow-up episode and saying, how did this case play out? So until that year passes, be safe and hopefully your assets don't get locked up. Behavior and Risk is brought to you by Capita Solutions. Behavior and Risk staff includes our research team, Sherry Xu and Jin Zhang, and our editing team, Qingying Gao and Athena Liu. Theme music by Crypt of Insomnia. The opinions presented here are solely those of John Burkhart and Rich Loria and do not represent those of Columbia University, Capita Solutions, or any other organization. We thank you for taking a chance on us today.